Welcome to the Economist Board for the May 2024 Watch Report. I'm John Nelson with M&A, and I'm joined today by Keith Prather of Armada. How you doing, Keith?
Doing fantastic. Doing fantastic.
So today, this is the first time we're going to be broadcasting broadcasting. Listen to me. That all of our flagship readers are going to get a chance. So I'm going to go a little bit more formal, put my tie on. And here in these videos, we're going to provide some additional context to what you see of the models and the narrative that you can read in the watch. We hope between the flagship and the watch, it really gives you a good overall picture of what's going on in the economy, and then you can zero in on the segments that most interest you and most impact your business to get an idea of what you need to do, the decisions that you need to make. So this first video, we're going to focus on industrial production for manufacturing. And then we're going to dive into the subsectors in a separate video of industrial production. So we'll take a look at electrical, computers, aero, motor vehicles, etc. And then we're also going to do videos that cover the overall transportation, so the moving of goods across the country. We're going to take a look at the construction sector. And then we're going to do a macroeconomic sector outlook. And part of that's going to focus on advanced retail sales or consumer spending, because we're going to focus on that because that's a really big indicator. Keith, you've always told me that takes up 70% of the overall GDP.
That's right. Yeah. And critical for what happens forward. So, yeah.
So with that rather lengthy intro, we're going to jump right on into our first model. Let me get some things out of the way. If I'm ever looking away from the screen and I'm talking, it's because I've got multiple screens up so I can see what I'm doing. I can also look at Keith. If he winces, then I know I've talked something out of school, which usually isn't so bad. But here we go. We're going to pop up industrial production for manufacturing. And so for those of you who have been following this particular sector closely, we're starting to tell a little bit of a different story. And, Keith, you and I were talking about this beforehand. If you look at it, just take a look at it at a glance, it looks like you're starting to build the slip and slide on the back end where we didn't have that kind of look before. But I like to always put these things into context. And I'm going to start off by putting a little drawing thing up here. And let me see if I can get my pen to work. So right up to about right here, and we're looking at that March to April timeframe. You can see it's about right here on both models. We're doing pretty much the same. We haven't changed the story. So this is reaching all the way out almost 9 months. We're getting through the election. We're getting through Christmas. We're getting through this summer of uncertainty. And the model's not seeing any scenarios that are really kind of changing much. But then they're looking out ahead of time. And for the first time, we're starting to see some real softening. Up to this point, we've seen some softening where it was kind of light. But now in general, as Keith, you like to call it, the increased bias towards negativity. So, evidently the model's not drinking enough to make it happy, but it's going into this whole extended period of time where for several months. Now, I say that I would advise everybody to take a look at this model and say, okay, the model's starting to pick something up. What did they say in April? April looked, fairly strong. Now it's starting to show a little bit of bias after March. And my gut feel says, based on looking at these models for a long time, let's give this about 2 or 3 months and see if the story stays the same. You're still going to be 8, 9 months out and ahead of this shift, if this shift is in fact going to be realized by the data. And so, Keith, I know you like to talk long-term. Do you want to talk long-term or you want to stay on this one?
Let's stay here for just a second, then I'll move it over.
Okay, go ahead. You're up.
Yeah. So one thing that I'm kind of looking at is a couple of things. So first of all, I like to look at the breadth of the cone of variability here. And this, John and I, we talk a lot about the models showing us, some scenarios that it's looking at, that it sees that would paint a picture more negative or more opportunistic picture on the upper end. And as we look at that cone of variability last time, we had we had about 4 points less or we had about 4 points more of opportunity last month than we do this month. So it's downshifting. And again, everything is kind of happening on the back end of that curve. And with the back end of that curve, it's just interesting that it's all kind of coming at the beginning of next year. And I think that as we think about the global supply chain, we think about where the manufacturing sector is, as John said, kind of getting through the election. You're talking about maybe a point where we're getting a little bit of sluggishness in new orders, especially coming through automotive, coming through some of the durable sectors, which this reads a lot of. Consumers still under pressure. Consumers really not digging out just yet. And overall, I think there's going to be some challenges with kind of what's going on with the economy overall. And I think it's starting to read that into the back end of this. And so that's what we're watching. I mean, but here's the bottom line. If you look, John, at the next slide, let's go ahead and kick over there for a second.
Yeah.
Let me trying to get that picture off of there. Kind of weird arrow. As we look at the gravity of that slowdown in the back half of next year, though, that's what we're watching. And it doesn't feel recessionary at all. It literally is just stagnating. And we've heard a lot in the economy. We'll talk more about that when we get to the macro video. But we're talking a little bit. You start hearing words like stagflation, and even though by definition we're not there yet, as you start to see a little deceleration in manufacturing or a little bit in retail and consumer spending, and as GDP kind of slows down a little bit, inflation is still staying pretty high, and so you get this sort of stagflation moment, and that's what we're seeing in the back end of this curve. Is it's stagnating, but it's not a deep recession, right? It's not what they would call a hard like a hard landing. It's more of what we've talked about a lot, which would be kind of a soft landing scenario, and it's kind of what the manufacturing model, at least for now, is telling us. And we can point to a lot of things. Like we can start to see some of this happening in some of the PMI data, so the purchasing managers indexes, and you see, around the world, you see manufacturing, data coming in, especially through May. And normally when we would see it really accelerating going into the peak season, it's a little lackluster. You're seeing just a slight uptick in what's happening in Europe. We get just a tiny uptick in Asia, but the US, Canada, Mexico somewhat flat right now. And so we are just getting this almost manufacturing malaise. And there's a lot of other things that go into the picture. We're not seeing input prices ease, which we normally would start to see that. We're starting to see just some slight hints of layoffs, but the labor market still stays very strong for the manufacturing sector. And so there's a lot of factors here kind of pushing back on the overall view. Because despite those increasing input costs, manufacturers are feeling a little bit of pushback now on their selling prices and being able to go to customers and get price increases to cover those higher costs. So you have a little margin compression kind of taking place in manufacturing. And so there's a lot going on here. And I think I like what John said. I hate to sound a little bit like the Federal Reserve, John, but they keep saying everything's gonna be data driven and it's data intensive. And I kind of understand that right now. We have a lot of anecdotes out there suggesting maybe things are slowing down. We have the model now showing us on the tail end of the curve, we call it, that there's a little bit of softening there, a little bit of downward bias, as you said. We're still waiting on that hard data to kind of tell us whether this downward bias continues or whether it suddenly reverses and gets pushed upward. And we could easily get an interest rate cut. You get one interest rate cut, and I think the tail end of this curve improves. We get a little uptick in consumer spending, and the tail end improves. So there's a lot of things that could happen here that could push it up. But at the moment, unfortunately, we have to kind of keep it a little bit negative and say that the bias right now is a lot of pressure and a little downward pressure.
And one thing I'm all about context, and I like to take a look at what's the severity of the swing that we're talking about. I draw your attention to the 20-year trend line that's generally going up. We're going to stay above trend line for looks like about 12 months before we finally start slipping below it. And how big is that swing? Well, we've seen similar swings of that magnitude, just not too long back ago. Take a look, right in here. Actually, I lost my, there we go. trying too hard with this little highlighter here.
I know. I
You know,
was
our swings, I mean, this is a really short period of time, and that's about the same magnitude as this drop right here that we're looking at. So yeah, it's not big. It's something that we've experienced in recent history, actually, in a compressed period of time. We're talking about 4 points. Well, 4 points is significant, but nevertheless, it's you know, it's like you pointed out, it's not doom and gloom. It's not recessionary. It's softening, and it is
right.
certainly within what we've seen since, well, since COVID and even the years before COVID, we've seen slips and rises that much.
Yeah, and I think the bottom line, if you deal with the manufacturing sector, so whether you're an accountant and you're looking at clients in manufacturing, or whether you're a supplier and you feed the manufacturing supply chain, I mean, I think you look at this data and you think about it in context. And you know, if you're supplying to the manufacturing sector, they may continue to want to keep inventories lean, knowing that if they're looking ahead and they're feeling a little more optimistic about, now to the end of the year, but they're a little nervous about what happens after that. They're going to keep inventories very lean going into 2025, and that would be one of the impacts from it. If you're a manufacturer, you're worried about margin compression, and so you're looking
Mhm.
at cost controls, and you're going out, you're negotiating with your suppliers, and you're negotiating with transportation, providers, and you're doing things to try and keep that margin compression under control. And there's just a lot of things happening up and down the supply chain. Just knowing though that they're going to have to keep production steady between now and the end of the year, maybe even have the ability to take on a little additional capacity, but followed by what looks like about a 4% drop if this back end of the curve holds for next year. And so it wouldn't feel good to them. Let's say it that way.
Yeah, exactly. Okay, well, that concludes our look at industrial production at the macro level. Hope you take the time to take a look at the individual videos where we'll jump right into those. Well, the very next one we're going to jump into is to the sectors. So if you want to find out a little bit more detail on your favorite sector, join in.
Yeah, and we'll be a lot smoother and a lot faster in the next ones, I promise. So there you go. We're getting the dust knocked off today. Take care.